Hi everyone, this video today is going to be on the statement of cash flows. I'm going to have two separate videos on the statement of cash flows just because it's very difficult, just like bonds and stocks, so I'm going to break this up. So today I want to just go over the basics of the cash flow, of the statement of cash flow. So this will be your fourth financial statement that you will learn. So far you know the income statement, which is revenue minus expenses, equals net income. The next statement is called the statement of retained earnings. The net income flows into the statement of retained earnings, and you figure out your final retained earnings balance. That retained earnings has its own account name, and that flows to your balance sheet. Your balance sheet, all assets, liabilities, and stockholders' equity. Retained earnings will go under stockholders' equity on your balance sheet. The statement of cash flows will be the last statement. The statement of cash flows explains the cash account. So if it does not affect cash, it will not be on your statement of cash flows. Here are examples of non-cash transaction. A non-cash transaction would be the following. You purchased land by issuing common stock. You debit land, you credit common stock. Did not touch cash, it will not be on your cash flow. Another example of a non-cash transaction. You purchased equipment and you issued a bond. You would debit equipment and credit bond payable. Okay, you can convert bonds into common stock. The bottom line is if it doesn't touch cash, then it's a non-cash financing or not on the non-cash at all and will not be on your cash flow. So be careful on those when you work in the lab. The cash flow statement explains the cash account. So what does it help investors and managers? Helps investors and managers to know if they have enough money to pay off the debts when they come due. You can tell investors that a particular company is selling off a lot of assets. It can tell investors that this company has issued common stock, that they've issued bonds, and it can determine, be able to explain this way by looking at the different activities. So for the cash flow statement, there's three different activities. There's the operating activities. That's what I'm going to go over first. There's investing activities. I'll go over second. And there's financing activities. So let's go over operating activities first. Also, before I begin, there's two different methods in the United States. There's the direct cash flow method and there's the indirect cash flow method. I'm going to go over the operating section for the direct cash flow method first. And then later in the video, I'll show you the indirect, just starting with it. Next week, we'll do an entire problem. Okay, so I'm going to go to the board and we're going to go over the direct cash flow method. Here's the first inflow. You'll have receipts from customers. Okay, so receipts from customers. And this is the direct method. Okay, receipts from customers. You'll always add that to the operating section. What's happened in that case? Originally, you debited accounts receivable, you credited sales revenue or service revenue. Now, those customers are paying you. So you debit cash, you credit accounts receivable. That goes in your operating section. Here's another one. Cash dividends received. Cash dividends received. So what's happened? You've invested, your company has invested in another corporation. So for example, Coca-Cola Corporation can invest in Advanced Micro Devices. They can purchase their stock. When Advanced Micro Devices pays Coca-Cola a dividend, Coca-Cola will debit cash, credit dividend revenue. So that dividend is in your operating section, and that will be a positive. Now I want good notes on that. Underline that. It said cash dividend received. That's in your operating section for the direct cash flow method. That will be positive. I'm going to teach you a different type of dividend later. Okay, so now we're going to have interest received from borrowers. Okay, so you lent money to somebody else, your company, and now they're paying you. Okay, you would debit cash and credit interest revenue. Okay, that affects the income statement. Anytime you see in a common theme, any transaction that affects the income statement will affect the operating section. So cash dividends received will also be a plus. Here's outflows for your operating section. Salaries and wages. This will be a minus. So what's happened? You debit salaries expense, you credit cash. Payments to suppliers. So payments to suppliers. This one, give me a few minutes to explain this entire transaction. So payments to suppliers. Your company originally purchased inventory on credit. So you debit inventory, you'd credit accounts payable. What happens with inventory when it's ultimately sold is you would debit cost of goods sold. Remember that account? So cost of goods sold is an expense and credit inventory. Well, cost of goods sold affects the income statement, so payments to suppliers will affect the operating section. It will be negative. When you ultimately pay off that liability, you would debit accounts payable and credit cash. So that's why that's in your operating section. Taxes and fines. Okay, so taxes, debit tax expense, credit cash. Fines. Debit fines, credit cash. Those ultimately affect the income statement. They would affect those negatively. You will subtract those. Okay? Interest paid to lenders. Interest, debit interest expense, credit cash. Interest expense affects the income statement. That's why it's under your operating section, okay? And it will affect it negatively. All right, so let me erase now, and let's go and explain another activity. It's called investing activities. Here's the good news. The direct method and indirect. It's exactly the same. So the only difference between the direct and the indirect cash flow method is the operating activity section. The investing, and when I teach you the financing, exactly the same. Okay, so investing. Before we begin, good notes. All long-term assets will be in the investing activity section. Okay, so I'm not going to be the same as the PowerPoint. I'm going to give you more. So I'm not really even looking at my PowerPoint. All right, so if you purchase a truck, oops, I don't want to give that example. If you sold a truck, that will be in your investing activity, and that will be positive. Okay, so what's the journal entry? Sold a truck. And You sold it at book value. It's nice and neat. You debit cash, you credit truck. That's it. So that truck is a long-term asset. You sold a truck, your cash went up. That's a positive. Okay, sold land. That's going to be a plus. Sold land. Debit cash, credit land. Sold a building. Debit cash, credit building. Okay, outflows. Outflows, I'm just going to work right from here. So outflows, you purchase a truck. What happened? You purchase a truck, so you debit truck and credit cash. That's a minus. Work right from here. Purchase land. Debit land, credit cash. Purchase a building. Debit building, credit cash. So the investing is exactly the same between the two methods. You want to think long-term assets. So you want to think long-term assets. Okay? All right, now let's go over the financing. Here's the financing activities. Okay, before we begin, all these type of items will go into financing. Bottom line is you're trying to get money for your company. You can borrow money. You can issue common stock. You can issue bonds. Those are all going to go through your financing. And when you issue common stock, you have to pay cash dividends. And I said pay, I didn't say receive, pay cash dividends. That will all go in financing. So again, let's have some good notes, okay? All right, so financing, issuing common stock. That's a plus. Issued common stock, nice and neat. Debit, cash, credit common stock. Issue bonds. Again, nice and neat. It's going to be issued at face value. We learned discount and premium. Just like common stock, you learned about par value. Issue bonds, debit, cash, credit, bond payable. Borrow money from bank. Okay. Debit, cash, credit, note payable. Remember, it has to affect cash in order to be on the cash flow. All right, so these are all inflows. These will all be pluses. Now let's do outflows. Okay. Redemption of bonds. What's happened? You went out, you purchased your bond back. So when you do that, you would debit bonds payable and credit cash. Okay? All right, paid off debt. What happened? You're going to debit note payable, you're going to credit cash, you're paying off debt. Note payable. Note payable will always be under financing. Whether it's short or long term, it will always be under financing. Okay? All right. Purchased treasury stock. Debit treasury stock, credit cash. So treasury stock will go under financing. These are all minuses. Paid cash dividends. That will go under financing. That's a negative. Paid cash dividends. debit retained earnings, credit cash. So that's your financing section, okay? All right, so now we completed the direct cash flow method. The direct cash flow method, if it directly affects cash, it's on your cash flow. If it doesn't, you do not put it on your cash flow. All right, now we're going to go over the indirect method. When you do both methods, you need a comparative balance sheet. So you'll analyze 2 years. You'll need an income statement, and you'll need other selected data. Again, next week we'll do an entire problem, not this week. All right, so now we're going to go over the indirect cash flow method, okay? So let me erase over here. Remember, direct and indirect for the financing activities and investing, it doesn't matter. So let's erase. Okay, so we're going to erase and we're going to label it indirect cash flow operating activities. Okay, now this will be different than the direct. Here's why. We know we complete accrual accounting. So the income statement includes a lot of accruals on there. So we talked about you could debit accounts receivable, credit sales, revenue. Well, it does not touch the cash flow until when? That's right, until it touches cash. So you will not include those accruals on your cash flow until you collect the cash. So what you're trying to do is reconcile a cash accounting to accrual accounting. So the bottom line is just learn these rules, don't fight them, and I promise you the cash flow will not be difficult. It's when you try to fight the rules that it gets very difficult. All right, so indirect method, what do you always start with? Number 1, always start with net income. Net income. Well, that's always a positive, right? If it was a loss, it would be negative. Next thing that you look for a loss on sale of fixed asset. You'll always add that. If it's a gain on sale of fixed asset, you'll always subtract that. Okay, here's why. I already told you fixed assets go in the investing section. Well, here's the problem. These particular items are already in net income. So what you have to do is clear them out. So what you're going to do is the opposite of how they originally affected net income. So a loss would normally subtract from net income. In order to get it out, you're going to do the opposite. You're going to add it. That will clear it out. A gain flows the same way as revenue. That will add to net income. In order to clear that out, you want to subtract that. And the reason being is that a gain or loss on sale of fixed asset affects the income statement, but it should be in the investing activity section. It's already in the net income when you use the indirect method. Okay, so now the next item we're going to look for is depreciation. And I promise you, you will always add depreciation expense back. Again, you're working with net income. This is why 97% of the companies use the indirect, because it's simpler for them to put together. All the items are already in net income. So we went through, the expenses, the revenue, it's already in that one number. Well, depreciation expense, let's think about it. What do? You debit depreciation expense, you credit accumulated depreciation. That doesn't affect the cash flow statement. However, it does affect net income, so you want to get it out of there. It originally subtracted, you add it back to clear it out. Okay? All right, now I'm going to go over here and I'm going to do current assets and current liabilities last. Here's why. If you don't understand what a current asset is and a current liability, you're not going to be able to do this. All right, so what are examples of current assets? Well, what's the definition? It's 1 year or less. It's going to change within 1 year or less. What's the biggest current asset? Cash. However, cash will not be in your operating activities. You're going to learn that will show way down the bottom of your cash flow statement. So let's start with current assets. What are examples? Accounts receivable. Let me write this in a different pen, okay? So you're clear. So accounts receivable. More. Supplies. More. Remember, 1 year or less. Remember, inventory. Prepaid expenses. Okay, so accounts receivable, supplies, inventory, prepaid expense, those are all current assets. All right, current liabilities. Remember, 1 year or less. Accounts payable. Salary payable. Interest payable. Accrued current liabilities. Okay? All right, let me write on the board. Not notes payable. Remember, I told you notes payable will always go in financing, whether it's short or long term, not notes payable. Okay, do not put that in there. All right, so now I'm going to go back here. We talked about current assets. Okay, so here's the rules. If current assets increase, they're not logical. So if they increase, you're going to subtract. If they decrease, not logical, you're going to add. Okay, current liabilities, if they increase, they're logical. So current liabilities, if they increase, you're going to add. If they decrease, you're going to subtract. Okay, this only works if you know what a current asset is and a current liability is. If you don't, it's not going to work. Okay? All right, now let me finish this. Here's the rules. So, if current assets increase, you're going to subtract. Why? Because they're not logical. If current assets decrease, what are you going to do? Right, you're going to add because they're not logical. So they decrease, opposite. All right, if current liabilities increase, they're logical. You're going to add. If current liabilities, running out of room, decrease, they're logical, you're going to subtract. All right, let me try to get rid of these markers. After all this, let me draw a line. Here's your total. This is going to be your operating activity, section, answer. So total that. Now be careful with your basic math. Add when you're adding, subtract when you're subtracting. And then you'll figure out that total. Okay? All right, I'm going to end that there just because next week I will have a different video, but I wanted to give you a start on the basics of the cash flow. Okay? All right. Good luck in the lab.